We've just seen a geopolitical shock that a lot of people are reacting to emotionally, while very few are actually breaking down correctly. A significant move has been announced by Trump involving Venezuela oil exports and enforcement actions that pull the United States, China, and indirectly Japan into the same macro framework. And before anyone jumps to conclusions, this is not about choosing sides or forecasting headlines. This is about understanding how shocks like this travel through the financial system and why markets almost always behave the same way in the early phase. When events like this hit, the first reaction is fear. Risk gets pulled off the table, capital shifts defensively, crypto sells off. That part is predictable, and it's nothing new. What actually matters is not the initial response, but what happens next, and why that sequence repeats every time. History is very clear on this. Geopolitical stress does not destroy markets over the long term, but it almost always creates short-term dislocations that confuse retail participants and reward prepared capital. The first mistake most people make is treating this as a crypto-specific issue. It isn't. This is an energy shock layered on top of a liquidity issue, layered on top of a global power struggle. Crypto sits downstream from all of that. XRP sits downstream from all of that. If you don't understand the upstream forces, you will misinterpret every price move that follows. Start with oil. Oil is not just a commodity. It's a macro control lever. It directly impacts inflation, production costs, transportation, and geopolitical leverage. When oil flows are disrupted or restricted, markets don't wait politely to see how things unfold. They de-risk first and ask questions later. That is exactly what we are seeing now, not panic, but precaution. This is also where history gets ignored. At the start of every major conflict over recent years, crypto corrected sharply. Russia and Ukraine, Israel and Palestine. Earlier geopolitical escalations, each time the narrative was the same: uncertainty, risk-off behavior, selling pressure. And each time those who sold emotionally at the beginning regretted it later, because those periods often mark strong long-term entry points once conditions stabilized. That doesn't mean prices can't go lower from here. They can. Pretending otherwise is dishonest. But lower prices during macro stress are not signals of failure. They are signs of temporary liquidity tightening. The system pulls back before it pushes forward again. What is happening with Venezuela fits this pattern precisely. This is about oil supply control and who gets to dictate terms in an evolving global order. The United States does not want energy influence shifting toward rival blocs, especially when those blocs are actively reducing dependence on the dollar. China's growing involvement in South America is deliberate and visible. Venezuela becomes a pressure point because it sits at the intersection of energy, politics, and global trade routes. Markets don't need an actual war to react. They just need uncertainty. And uncertainty is exactly what causes short-term selling across risk assets, including crypto. That doesn't mean crypto is broken. It means crypto is behaving exactly like other risk assets when liquidity tightens. This is where disciplined thinking becomes critical. You don't analyze this by asking whether XRP is good or bad. You analyze it by asking what happens to liquidity when oil prices move, when inflation expectations shift, and when central banks are forced to respond. Crypto does not move in isolation. It moves when liquidity expands or contracts, and geopolitical events often accelerate that process in one direction before reversing it. If you feel uneasy right now, that is normal. Markets are designed to create discomfort during transitions, but discomfort does not equal danger. Often, it signals opportunity later once the sequence completes. The key is not reacting too early or assuming the first move is the final move. To understand what is happening now, you have to step back and study how markets behave during every major geopolitical disruption in recent years. This is not the first time this pattern has appeared, and it will not be the last. The recurring mistake is assuming each new conflict is different in a way that permanently breaks markets. History does not support that. Look back at the start of the Russia-Ukraine conflict. The initial reaction was severe. Stocks sold off. Crypto sold off harder. XRP, like most risk assets, faced immediate downside pressure. The narrative was driven by fear, war, instability, sanctions, uncertainty. Retail rushed to de-risk, convinced this marked the start of a prolonged collapse. What actually happened after that first wave tells you how these events really work. Once the shock was absorbed, markets stabilized, liquidity adjusted, capital that had stepped aside began to return. Those who accumulated quietly while sentiment was worst ended up in far stronger positions than those who reacted emotionally. The same pattern played out during the Israel-Palestine escalation. Short-term downside, heavy fear, aggressive headlines, then normalization once markets process the new information. This isn't optimism, it's pattern recognition. Geopolitical events create temporary liquidity stress. Investors don't suddenly decide assets are worthless. They decide they want flexibility. They move to cash. They move to perceived safety. They wait. And while they wait, prices fall. That is where opportunity forms, not because conditions are good, but because price reflects short-term fear rather than long-term utility. XRP has followed this exact script repeatedly. In the opening phase of conflict, it tends to decline with the broader market, not because something is wrong with XRP specifically, but because it is treated as a risk asset during uncertainty. Correlations tighten. Everything moves together. Fundamentals don't matter in the moment. Liquidity does. What separates experienced participants from emotional ones is understanding that this phase is transitional. It is not where long-term trends are decided. It is where weak hands exit and strong hands prepare. Smart capital does not ask how bad things look right now. It asks what conditions will look like after markets adapt. This is where most people get shaken out. They assume the first reaction is the final outcome. They forget that markets are forward-looking systems. Fear gets priced in early, often excessively, and then recalibration follows once clarity improves. By the time certainty returns, prices have already moved. With Venezuela, oil, and global power dynamics colliding, we are seeing the same early-stage behavior. Risk-off positioning, selling pressure, anxiety. None of this tells you where the market will be months from now. It only tells you where it is while uncertainty is highest. This is also why headlines feel loudest at the beginning. Media amplifies fear because fear captures attention. But markets do not trade on headlines alone. They trade on flows. And once those flows stabilize, price follows. So the real question is not whether XRP or crypto can drop further in the short term. They can. The real question is whether this event permanently damages the system or simply creates another liquidity reset before the next phase. History strongly supports the latter. This is where many people lose the thread entirely, because they treat oil, inflation, interest rates, and crypto as separate stories. They are not. They are parts of the same system. If you don't understand how they connect, you will misread both the downside and the recovery. Oil is one of the most powerful inputs in the global economy. It feeds directly into transportation, manufacturing, food prices, and ultimately, inflation. When oil spikes or supply routes are disrupted, inflation expectations rise. When oil stabilizes or falls, inflation pressure eases. That matters because central banks do not respond to crypto. They respond to inflation and employment. Crypto reacts afterward. The chain reaction usually looks like this. A geopolitical shock hits an energy producer or key supply route. Markets sell risk assets as uncertainty rises. Oil becomes volatile. Then if supply adjusts or demand weakens, oil prices stabilize or decline. As oil cools, inflation data improves. Once inflation is under control, central banks gain room to cut rates and reintroduce liquidity. This is the part most people miss. Short-term conflict often sets the stage for longer-term easing. It feels counterintuitive, emotionally, but it is how the system operates. Lower oil prices reduce inflation. Lower inflation gives central banks cover to cut rates. Lower rates mean cheaper capital. Cheaper capital eventually flows back into risk assets, including crypto. This is why experienced investors watch macro indicators, not just headlines. They watch oil. They watch inflation data. They watch employment numbers. Most importantly, they watch liquidity, because liquidity is the real driver of asset prices, not sentiment. When easing resumes or rate cuts accelerate, capital does not stay parked. It moves. It looks for growth and asymmetry. Historically, crypto has benefited strongly when liquidity expands, not because it is safe, but because it is highly sensitive to excess capital. XRP sits within this same dynamic. When liquidity contracts, XRP sells off with everything else. When liquidity expands, XRP can benefit disproportionately because it is already positioned as a bridge asset within financial infrastructure discussions. It does not need retail excitement. It needs capital flow. Timing matters here. Markets do not wait for policy announcements. They move when expectations shift. If investors believe rate cuts are coming, positioning begins before the first cut. If they believe liquidity is about to increase, allocation starts while sentiment is still negative. That is how cycles actually turn. Right now, we are in the uncomfortable middle. Uncertainty is elevated. Selling pressure exists. Liquidity is tight. That is when narratives feel darkest and conviction is lowest. But this phase does not last forever. It transitions when data changes and when central banks are forced to respond. When people say things have to get worse before they get better, that is not doom. That is mechanics. It is the system processing stress before resetting. The key is recognizing where you are in the sequence, not treating the current moment as permanent. To understand why this moment matters, you also have to zoom out beyond Venezuela and oil and look at the broader power struggle that has been building for years. This is not about one country or one blockade. It is about who controls energy, who controls liquidity, and ultimately who sets the rules of the global financial system. China has steadily expanded influence across South America, Africa, and parts of Asia through energy deals and infrastructure investment. Venezuela sits at the center of that strategy, resource-rich, politically isolated, and willing to operate outside traditional U.S.-aligned systems. That makes it valuable to China and uncomfortable for the United States. The U.S. response is not random, it is defensive. This is also where BRICS enters the picture. The push toward alternative trade systems, local currency settlement, and commodity-linked frameworks challenges dollar dominance. The U.S. does not need to lose a war to lose influence. It only needs global trade to gradually move away from the dollar. Energy and money are inseparable in this dynamic. Control energy and you influence inflation. Influence inflation and you influence rates. Influence rates and you control liquidity. That is why oil matters so much. It is leverage. When leverage shifts, financial systems adapt. This is where neutral settlement infrastructure becomes important. Not assets tied to one ideology or nation, but systems that move value efficiently between parties that do not fully trust each other. That is why periods of geopolitical fragmentation often increase interest in settlement layers rather than speculation. This does not mean XRP becomes immune to volatility. It does not. Early in these shifts, XRP can face as much downside pressure as anything else, but structurally, it becomes more relevant, not less. Volatility clears weak positioning. Infrastructure relevance builds quietly underneath. The challenge for most people is holding both truths at once. Prices can fall in the short term, while the long-term case strengthens. These are not contradictions. Markets punish impatience and reward preparation. The U.S. response to rising competition is not abandoning its system, it is reinforcing it. That means more liquidity tools, more monetary flexibility, and pressure on central banks to support growth. That is why conversations around rate cuts, Fed leadership, and aggressive easing keep returning. They are economic necessity, not noise. So while this moment feels chaotic, it is revealing. It shows where pressure points exist, how nations respond when dominance is challenged, and which systems get leaned on during instability. Energy shocks expose weaknesses, liquidity responses reveal priorities. Infrastructure gets stress-tested in real time. Pulling this together, what you are witnessing is not a single event, it is a sequence. Energy pressure, geopolitical tension, liquidity tightening, then policy response. Markets always move in this order, even when it feels chaotic in the middle. Short-term volatility is reasonable. Fear-driven selling is reasonable. It is entirely possible that XRP and crypto see lower levels before stabilizing. Denying that does not make you smart. It makes you unprepared. But lower prices during macro stress are not signals of collapse. They signal constrained liquidity. What determines the next phase is not headlines, not speculation, and not short-term price action. It is liquidity. M2, interest rates, and central bank behavior drive markets. When inflation cools, oil pressure eases, and data forces central banks to respond, liquidity returns. When liquidity returns, risk assets reprice. Markets bottom when uncertainty is high and sentiment is washed out, not when things feel good. That is because markets move on changes in expectations, not absolute conditions. For XRP, discipline matters. XRP is not dependent on a single geopolitical event. It is positioned around settlement, liquidity, and infrastructure, areas that become more important as the global system fragments. That does not shield it from drawdowns, but it explains why it remains part of long-term discussions. The mistake is trying to force certainty from uncertainty. People want guarantees and timelines. Markets do not offer that. Those who survive cycles understand process, manage risk, and avoid emotional decision-making. That is the mindset required here. Calm, informed, patient, not blind optimism and not panic. Awareness of where we are in the sequence and what drives the next phase. And to be clear, this is for educational purposes only. Nothing here is financial advice. I am not telling you to buy, sell, or hold any asset. You are responsible for your own research and decisions. Crypto is volatile and risky. If this added value, reflect instead of react. That alone puts you ahead of most participants. I will continue breaking these situations down with context, not hype, so you can think clearly even when markets feel unstable.